Is the Kotak T-ULIP Next plan a true evolution in ULIPs or just a repackaged version with a futuristic name? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. This is a non-participating unit-linked life insurance individual savings product. Some of the key features of the policy are: you can choose a high sum assured multiplier to ensure robust life cover. You get to enjoy the flexibility to pay premiums either for a limited period or across the entire policy term. And you can also access a range of investment strategies to suit your risk appetite and financial goals, and get back 100% of your premium allocation charges starting from the end of the 15th policy year. And you can also receive 1 to 2 times the mortality charges refunded on survival beginning from the 11th policy year, and earn loyalty additions as a reward for staying invested, so boosting your fund value over time. This can also strengthen your coverage with optional rider benefits. So these are some of the key features of the policy, and there are benefits like death benefit, maturity benefit, and loyalty additions. And also there are 2 investment strategies for you to choose from, and also there are up to 10 fund options that you can choose from. So these are some of the benefits and options you have that you can choose from this policy. But as a ULIP policy, there are also various charges that will be deducted from your premium, like premium allocation charge, policy administration charge, fund management charges, switching charges, partial withdrawal charge, discontinuance charge, mortality charges, premium redirection, alteration charge. So all these charges will be deducted from your premium before they invest in the fund option or in the investment strategies you have opted for. So other market related products in the market don't charge these many charges. So what will happen in this policy is, over a period of time, these charges will pull down your returns significantly. Now let us take a look at the advantages of investing in this policy. You get to enjoy 1x return of premium allocation charge and up to 2x return of your mortality charges on survival, and you can also gain access to your investment through partial withdrawals after completing 5 policy years, and you get to boost your investment anytime with top-up premiums whenever you have surplus funds. So you get to choose between fund options or modify future premium allocation as per your changing goals, and you have the option to reduce your sum assured while keeping your premiums unchanged. And you can also enhance your protection with add-on covers for critical illness and accidental death, and you get to benefit from 12 free switches and 12 free partial withdrawals post the 5-year lock-in period each year. So these are some of the advantages of the policy. Some of the disadvantages are: there is no liquidity in the first 5 policy years. Though the plan invests in the market, the returns are not up to the mark and the sum assured is inadequate. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. And if you want to know more about certain aspects of the policy, you can definitely go through the policy brochure. Now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to analyze the IRR of this policy by calculating the internal rate of return of the benefit illustration given in the policy brochure to help us make a more informed decision. So here, for calculation purpose, let us now assume that a 40-year-old male has chosen to invest in this policy with a sum assured of 50 lakhs. So the policy term is 40 years and the premium paying term is 10 years, and the annual premium is 1 lakh. The maturity benefit is the fund value at the end of the policy term. Here we have calculated the IRR based on 2 potential return scenario. One is the worst case performance, and is the best case scenario. So in the 4% per annum, which is the worst case scenario, the fund value at maturity is 13.50 lakhs with an IRR of just 0.85% as per the policy's maturity calculator. And at 8% per annum, which is the best case scenario, the fund value grows to 79.88 lakhs, offering an IRR of 5.99% as per the policy's maturity calculator. While the 8% return may seem initially very attractive, it still falls short when compared to other market-linked investment options, many of which consistently outperform inflation over the long-term period. Moreover, the policy lacks transparency in its fund management and comes with high charges that eat into returns. And adding to the concerns, the life cover offered under this plan is relatively low, making it a suboptimal choice for both protection and long-term wealth creation. So these are some of the things that we need to keep in the mind before deciding to invest in this policy. So now as this policy is not giving us a desirable outcome that we need, let us now move on to a different kind of analysis, which is that comparative analysis, where we are going to explore an alternative strategy in which we will invest in insurance and investments separately to better understand how to balance risk and return. So here we are going to keep the life cover and investments separate just to ensure better financial efficiency and transparency. So using the same parameters from our earlier example, here for life cover purpose we have opted for a pure term life insurance policy offering a 50 lakh sum assured with a 30-year policy term and a 10-year premium payment term which cost around 30,900 rupees per year as an annual premium. This is significantly lower than the 1 lakh annual premium required under the Kotak policy, allowing a surplus of 69,100 rupees each year that can be invested as per your risk appetite. So for investment comparison, if you are a conservative investor, you can choose PPF, Public Provident Fund, and if you are an aggressive investor who is willing to take a lot of risk, you can opt for equity mutual funds. Here, just for a better reference for you, we have opted for both scenarios as an example. The minimum investment in PPF is 500 rupees, but for this analysis, we have assumed annual contributions are adjusted using the saved 69,100 rupees. At maturity, the PPF corpus can grow into 80.38 lakhs. So the IRR for the pure term plus PPF combination is 6.01%, which is tax free. Under the pure term and equity mutual funds combo, the equity investment grows to 4.06 crores before tax, and after accounting for the capital gains tax, the post-tax corpus stands at 3.57 crores. So the post-tax IRR is 10.47%, far exceeding both inflation and returns compared to Kotak policy. So if you have any doubts regarding how the equity mutual fund tax is calculated, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So both strategies not only generate significantly higher corpus but also provide better transparency and flexibility. The IRRs in these alternatives beat inflation and are better aligned with the level of risk taken, something that the Kotak policy fails to deliver. So what is the final verdict then? Is investing in the Kotak T-ULIP Next plan worth it or not? The Kotak T-ULIP Next plan, as the name suggests, combines term insurance with a unit-linked investment component. It offers life cover for the entire policy term along with the maturity payout of the accumulated fund value. While long-term investments are generally expected to deliver strong returns and support wealth creation, this plan falls short of that expectation. Despite its long tenure, the Kotak policy fails to generate inflation-beating returns, largely due to high charges and inefficient fund management, and it also has a high agent commission. As a result, it's not effective for long-term wealth accumulation and could leave you financially unprepared when your life goals come due. So the plan suffers from a few drawbacks such as inadequate life cover and suboptimal investment returns. This combination makes the Kotak policy an unattractive option for individuals seeking financial security and long-term growth. A better approach is to separate insurance and investment, to choose a pure term life insurance policy to secure your family's financial future. So you can invest the remaining funds in cost-effective equity-based instruments which offer higher inflation-beating returns.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.